Welcome to Iron Financial. All right, today we're tearing down Delta Airlines' latest earnings report. And on the surface, you see some wildly conflicting signals. We're talking record revenue on one hand, but a net loss on the other. Our job here is to dig deep into the foundation and figure out if this thing is built of solid steel or if they're just papering over some serious cracks. We're here to help you forge a stronger portfolio by cutting right through all that market noise. Let's get to it. We're running a full structural analysis today. Here's the game plan. We'll start with those confusing headlines that have everyone scratching their heads. Then, we're going to drill deep into the revenue engine. After that, we'll stress test the cost structure, examine the balance sheet, which is really the bedrock of any company, and finally, we'll look at the flight path ahead to deliver our final no-nonsense verdict. Okay, analysts, let's just start with that big picture, because as the market bellwether for the entire airline industry, these signals, they really matter. And right now, the market has no idea what to make of this report, and to be honest, neither do I. It is a complete mess of contradictions. So let's just lay out that fundamental contradiction right from the get-go for everyone watching. All right, the bull case starts right here on the left side of this slide. You're looking at a record-setting adjusted revenue of $14.2 billion for the quarter. Now, not only is that a record, but it's up 9.4% year over year, and it decisively beat Wall Street estimates. That is an incredibly powerful top line, and it shows you that the demand for their product is absolutely solid.
Solid demand, sure, but then you look at the right side of the screen, a GAAP net loss of almost $300 million, a loss per share of 44 cents. I mean, you can talk about demand all day long, but there's an old saying, revenue is vanity, profit is sanity. From where I'm sitting, it looks like they're flying packed planes, but are literally losing money doing it. That's not a business model, that's a charity. So what is the real story here? Are they strong, or are they quietly bleeding out?
To understand the strength, you have to look under the hood. You absolutely cannot just look at that headline loss. We need to analyze where that record revenue is actually coming from. See, for years now, Delta has been on a mission to do something most airlines simply can't pull off: decommoditize air travel. They've been working to build a fortress of high-margin, durable, and less cyclical revenue streams. This quarter, despite all the noise, is the proof of concept for that entire strategy. Let's be perfectly clear about what we're looking at here. This isn't about selling cheap seats in the back of the plane anymore. That's a commodity game, it's a race to the bottom, and you can't build a fortress on that. No, Delta's strategy is all about premium cabins, a world-class loyalty program, and building out these massive non-ticket revenue streams, like their maintenance, repair, and overhaul business, or MRO. These are the steel beams supporting the entire corporate structure, specifically designed to withstand turbulence in the economy, or, as we're going to see, in the fuel markets. Now let's look at the numbers that prove it. Okay, this slide right here shows the pillars holding up Delta's revenue fortress. First, you've got premium revenue, up a massive 14%. Then you have loyalty revenue, which is an incredibly high-margin engine, up 13%. And then there's the main pillar, that incredible American Express partnership, which brought in over $2 billion this quarter alone. These aren't just ticket sales. They're high-margin, durable streams that competitors just can't easily replicate. This is their moat.
Look, these are impressive numbers, analyst. I'll grant you that. Nobody can argue with double-digit growth in your most profitable segments. But here's the question you absolutely have to ask. Is this some new, durable reality? Or is it just the last gasp of that post-pandemic revenge travel craze? The consumer is getting squeezed by inflation. How much more can they really squeeze from premium fares and credit card deals before that consumer finally taps out and starts looking for the cheapest seat again?
Lead analyst, the CEO is confident because he sees this foundation being built in real time. When Ed Bastian says durability of our financial foundation, he's not just talking about one good quarter. He's talking about the very structure we just outlined on the previous slide. He's making the point that even with a huge spike in fuel costs, a major headwind, their adjusted earnings are still up over 40%. They're weathering the storm specifically because this premium core is so incredibly strong. Okay, we've talked about the money coming in, all the shiny premium revenues. I get it. Now let's talk about the money that is gushing out, because that's where the real risk is hiding. A strong engine doesn't matter one single bit if you have a massive fuel leak and the chassis is getting more expensive by the mile. It's time we started looking for the cracks in this so-called armor. All right, first, let's clear up that gap loss that you brought up earlier. The skeptic is right to point it out, but it's absolutely crucial for any serious investor to see why it's there. As this slide shows, the biggest driver was a $550 million non-operating loss on investments. This has nothing to do with the core business of flying planes. When you adjust for that one-time item, you see the core airline business was actually profitable, with adjusted pre-tax income of $532 million and an adjusted EPS of 64 cents.
Fair enough. You have to separate the one-time hits from the core operational performance. I'll give you that. But that's not the only cost pressure, not by a long shot. Let's talk about the costs that are very much a part of the core business, the ones that are rising and pose a very real threat to future profitability.
Fuel. It is the single biggest variable cost for any airline, and it's on an absolute tear. The price per gallon jumped 7% year over year. That translated directly to total adjusted fuel expense jumping 8%, to a staggering $2.6 billion for the quarter. This is a direct, brutal hit to profitability, and it's a factor they absolutely cannot control, especially with the war in Iran creating massive volatility in the global energy markets.
And it's not just fuel. This is the part that really, really worries me. Their non-fuel unit costs, what the industry calls CASM, or the cost to fly one seat for 1 mile, are up 6% excluding fuel. Now, the report tries to explain this away, saying it's due to lower than planned capacity growth and higher recovery costs. But let me translate that for you. To me, that sounds like they're paying more money to run a less efficient operation. They're bringing in more cash from those fancy premium tickets, but it's just burning up faster on the tarmac before the plane even takes off.
This right here is the most critical part of the entire analysis. Forget the noise. Forget the quarterly earnings miss by a single penny. This is where you see the real strength being forged. While the market is distracted by volatile fuel prices and these short-term cost pressures, Delta is quietly doing the heavy lifting and building an absolutely ironclad balance sheet. This is the true foundation of the company. Everything starts with cash. It is the lifeblood of any company. In just one quarter, Delta's core operations generated $2.4 billion in operating cash flow. This is not some accounting trick. This is the raw material for building real financial strength. And this is what they did with it. After paying for all their new planes and all their fleet upgrades, investing back into the business, they were left with $1.2 billion in free cash flow. This is pure surplus, pure financial power that they can then deploy to strengthen the company. So where did they deploy it? They didn't squander it. They attacked their biggest vulnerability, debt. In a world of rising interest rates, they used that power to pay down their adjusted net debt to $13.5 billion. This is the smartest, most defensive move a company like this can possibly make right now. That $13.5 billion figure represents a 20% drop in net debt from just last year. But here's the real headline, the part you can't ignore. Delta now has less net debt than they did before the pandemic. They have completely repaired their balance sheet from the crisis and actually made it stronger than ever. This is the heavy lifting that separates a durable investment-grade operator from the rest of the competition. Okay, I have to be honest. The cash flow and the debt reduction numbers are strong, very strong. I can't argue with that data. Paying down $760 million in debt in a single quarter is incredibly impressive. And having 86% of your debt at a fixed rate of 4.6% in this environment, that's just incredibly smart financial management. It insulates them from rising rates. But, and this is a big but, is a strong balance sheet alone enough to protect you from a full-blown Category 5 hurricane in the energy markets? A fortress is great, but it can still be washed away by a big enough wave. That's exactly the right question to be asking right now. The foundation is strong, we've clearly established that, but the forecast is calling for storms, no doubt about it. The strength of that foundation is about to be tested. So let's look at the guidance Delta gave for the next quarter and see exactly how they plan to navigate all this turbulence. The key here is that combination of revenue and capacity. They're guiding to low teens revenue growth year over year, but on flat capacity. That shows incredible discipline. They are not chasing growth by adding flights into a high-cost environment. They're focusing on maximizing revenue from the flights they already have, and that is the only path to profitability in this kind of market. I see discipline, sure, but I also see a company that's bracing for impact. They're focused on survival. Look at that operating margin, 6 to 8%. That is razor thin. There is very little room for error there, and that wide EPS range, from $1 to $1.50, tells me there's a huge amount of uncertainty baked into their own forecast. That uncertainty has a name, and its name is fuel. $4.30 a gallon, that is the number on this slide that should keep every single investor up at night. That is the assumption their entire Q2 forecast is built on. The report explicitly mentions a potential $2 billion increase in fuel expense for the coming quarter. They point out that their own refinery provides a $300 million benefit, which is good, but that's a drop in the bucket compared to the tidal wave of cost that is coming their way. That is a brutal, brutal headwind.
All right, so we've drilled down into the numbers. We've stress tested the revenue engine, we've analyzed all the cost pressures, and we've inspected the foundation of the balance sheet. It all comes down to this one simple question. At this moment, with all this information, is Delta Airlines an opportunity or is it a trap?
The bull case, my case, is built on a foundation of pure iron. You have these diversified, high-margin revenue streams from premium and loyalty that are far less volatile than the core business. You have powerful free cash flow, $1.2 billion in Q1 alone, that's being used intelligently to aggressively pay down debt to levels below 2019. This is an investment-grade company built to last. It is a fortress designed to withstand market cycles.
And the bear case, my case, says you're building a beautiful fortress in the direct path of a Category 5 hurricane. You have uncontrollable extreme fuel price volatility. You have rising internal costs that are eating away at efficiency. And you have massive geopolitical risk from the Iran war that could send fuel prices even higher. Any one of those forces could blow any fortress down. This is a classic value trap for anyone who is underestimating the severity of the coming storm.
So the verdict really comes down to your own personal risk profile and your time horizon. The headwinds are severe. There is absolutely no denying that. The storm is real. But the underlying structure of this business, its revenue diversification and its balance sheet, is stronger than it has ever been. For investors who can handle that turbulence and look to the long term, this could represent a significant opportunity to own a best-in-class operator.
But for those who can't stomach that kind of volatility, the external risks are simply too high and far too unpredictable right now. And that's the breakdown. We've given you the bull case and the bear case, the strengths of the foundation and the force of the storm. Thank you for joining us on Iron Financial. Now you have the framework to make your own call.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.